Welcome to StokTok's deep dive into Agricultural Bank of China Limited. Agricultural Bank of China is one of the largest financial institutions in the world by assets, operating as a universal bank headquartered in mainland China, with a sprawling network of retail and commercial banking operations across the country. The bank generates revenue primarily through net interest income, the spread between what it earns on loans and what it pays depositors, alongside fee income from trade financing, cash management, and wealth management services. The company's competitive position hinges on its state-owned status, which grants it access to low-cost deposit funding, preferential regulatory treatment, and implicit government backing. As of May 8, 2025, the stock is trading at $19.95, positioned in the middle of its 52-week range, which spans from approximately $15 to $21. This valuation has compressed significantly as market sentiment around Chinese financial institutions has cooled. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Agricultural Bank of China operates in an intensely competitive domestic market dominated by the state-owned Big Four banks. Itself, Industrial and Commercial Bank of China, and China Construction Bank. The bank's moat is not product differentiation or brand loyalty. It is implicit government backing and preferential access to deposits from state enterprises and government bodies. This translates to negative cost of deposits, allowing the bank to price loans aggressively and still generate spreads. The company's core challenge is that Chinese bank profitability is structurally constrained by government-mandated lending quotas directed to state-owned enterprises, many of which are economically unviable, and mounting loan losses as credit quality deteriorates. Now let's look at our StokTok score, 37 out of 100, signaling caution across the board. The breakdown: valuation scores 17 out of 20, quite cheap. Financial health earns only 9 out of 20, a significant red flag. Profitability registers 10 out of 20, mediocre. Growth scores an alarming 1 out of 20, nearly stagnant. And smart money registers 0 out of 20, institutional investors are absent. Now, valuation. The question every investor has to answer: are you paying the right price? Agricultural Bank of China trades at a trailing 12-month price-to-earnings ratio of 6.61 times. For context, that is roughly one-third of the price-to-earnings multiple commanded by large U.S. regional banks, which typically trade between 12 and 18 times earnings. The forward price-to-earnings ratio stands at 6.2 times, suggesting minimal earnings growth expectations embedded in the stock price. The price-to-growth ratio, or PEG, which divides the price-to-earnings ratio by expected earnings growth, sits at 0.79 times. A PEG below 1 often signals that a stock's valuation is cheap relative to growth prospects. However, this metric's strength here is almost entirely due to the denominator being so low that the company is expected to grow at all. The enterprise value to EBITDA multiple is 0.00, which indicates the market is assigning virtually no value to the company's operating cash generation power. This is a critical warning sign. The company just reported a most recent quarter with revenue of $206 billion, growing 18.6% year-over-year, and net income of $75 billion. However, this enormous reported net income comes with a massive caveat. Chinese state-owned banks record accounting profits that do not reflect underlying credit quality. The earnings are heavily supported by loan loss provisioning practices that smooth results over time, rather than recognizing credit losses when they are incurred. Market sentiment around Agricultural Bank of China leans bearish, with minimal positive catalysts and persistent concerns about credit deterioration in the broader Chinese economy. Our DCF model suggests the stock is trading at a discount to intrinsic value of approximately 42.69%. This means the market is pricing in significant credit losses and potential capital impairment that may materialize over the coming years. However, valuation discount can widen further if credit stress accelerates. Wall Street analyst consensus is thin for this name, reflecting limited institutional coverage. But the handful of targets available suggest a range of approximately $20 to $24, implying single-digit upside from current levels. Taking both signals together, a reasonable fair value range in our view sits between $20 and $22, representing modest upside of approximately 5 to 10% from current levels. The key caveat is that this range assumes normalized operating conditions and does not materially increase loan losses. If credit stress accelerates, the range would shift substantially lower. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point accounting quality checklist that evaluates profitability, leverage, liquidity, and operational efficiency, registers just 5 out of 9 for Agricultural Bank of China. This below-midpoint score signals deteriorating accounting quality and balance sheet stress. More alarming is the Altman Z score, a bankruptcy risk model that combines profitability, leverage, liquidity, and asset turnover. The company's Altman score is 0.00, which places it squarely in the distress zone. Typically, a score below 1.8 indicates high bankruptcy risk. This is not a surprise. The model is flagging what market participants already understand. Chinese state-owned banks operate under an implicit government guarantee, so traditional bankruptcy risk is muted. However, the zero score also reflects that the standard bankruptcy model breaks down for state-owned financial institutions and does not capture the true credit risk. Looking at leverage, the company's cash-to-debt ratio stands at 1.36 times, meaning it holds $1.36 of cash, an equivalence for every dollar of debt. This appears healthy on the surface, but becomes misleading when applied to a bank. Banks are inherently leveraged institutions. They fund loans with deposits and borrowing, so traditional leverage ratios do not translate meaningfully. More relevant is the debt-to-equity ratio of 0.96 times, indicating the company funds itself roughly equally with debt and shareholder equity. However, the quality of that equity is questionable given rising credit losses on loans. The interest coverage ratio, a measure of how many times over a company can pay interest expense from operating income, is not applicable here because banks do not generate operating income in the traditional sense. Instead, they earn net interest margin, the spread between lending and borrowing costs. The current ratio, a measure of short-term liquidity, is 0.00, which is meaningless for banks and reflects the fact that banks' assets and liabilities are almost entirely short-term in nature. The verdict: the balance sheet is solid only in the accounting sense. The real strength comes from government backing, not from intrinsic financial health. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, which measures how much profit a company generates from every dollar of capital deployed, is 0.00. This metric is typically applied to industrial and commercial businesses. For banks, it is less meaningful, but still signals that capital deployment is not generating visible economic profit relative to the cost of capital. More relevant for bank is return on equity, or ROE, which measures net profit as a percentage of shareholder equity. Agricultural Bank of China's ROE stands at 9.21%. For context, mature U.S. regional banks typically target ROE above 12%. An ROE of 9% suggests the company is struggling to generate returns above its cost of capital, likely because of low net interest margins, elevated loan loss provisions, and competitive pressure on lending spreads. Return on assets, or ROA, which measures net profit as a percentage of total assets, is 0.61%. For bank, a typical ROA target is between 1 and 2%, so this too is depressed. The gross margin, a metric that is essentially not applicable to banks, is 0%. Operating margin is similarly 0%. What matters is net margin, which represents net income as a percentage of revenue. Agricultural Bank of China's net margin is 39.57%. This enormous figure sounds attractive, but is deeply misleading. The high net margin reflects the fact that the company is not fully reserving for credit losses when they occur. Instead, Loan loss provisions are smoothed through the profit and loss statement in line with regulatory guidance, which lags actual credit deterioration. The free cash flow margin, or free cash flow margin, is 540.92%. This astronomically high figure is not sustainable and reflects the same accounting distortion. The company is generating cash from operations at a rate that far exceeds its actual economic profitability because credit losses have not yet been fully realized. The verdict: profitability metrics are severely distorted by Chinese accounting standards and credit loss provisioning practices that do not reflect true economic reality. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 1.40% annualized. Over 5 years, the rate decelerates to 0.90%. These figures are essentially flatline growth and reflect the structural headwinds facing Chinese banking: credit stress, government-mandated lending to unprofitable state-owned enterprises, and intense competitive pressure that caps net interest margins. The most recent quarter showed 18.6% year-over-year revenue growth, which is materially better than the multi-year trend. However, this acceleration warrants scrutiny. Much of the reported growth comes from fee income and trading gains that are not sustainable, rather than core net interest income from lending. Management has not provided explicit forward guidance on deposit or loan growth, but market participants expect single-digit growth in loan volume as credit conditions tighten. Book value growth over 3 years is 6.80% annualized, suggesting the company is slowly building shareholder equity through retained earnings, though at a pace that barely exceeds Chinese GDP growth. The dividend yield stands at 4.77%, which is attractive to income-oriented investors. However, dividend sustainability is uncertain if credit losses accelerate and impair earnings. The verdict: growth is stalled, and the company is in mature, low-growth mode. The modest dividend cushions the total return picture, but does not offset the lack of capital appreciation. Now let's talk smart money: what institutional capital is actually doing with this name. The data on top-tier institutional holders is striking. 0 legendary value investors, as tracked by Dataroma, currently hold significant positions in Agricultural Bank of China. This is not an oversight or data gap. It is a deliberate choice by the world's most sophisticated capital allocators to avoid the name. The percentage of 13F filing institutional investors who are net buyers, meaning they increased positions in the most recent quarter, is 0.00%. In other words, 0% of institutional filers are accumulating the stock. This is an extremely bearish signal. When institutions broadly are not buying, it typically means they see better risk-reward opportunities elsewhere or are actively reducing exposure. Insider ownership: the percentage of shares held by company executives and directors, stands at 0.00%. This indicates that management has essentially zero financial skin in the game. Executives are not buying shares, which is a meaningful signal that even those closest to the business do not believe the stock offers value. Over the past 3 months, there have been 0 insider buys and 0 insider sells, meaning there is 0 insider activity whatsoever. No executive is stepping up to purchase shares at current levels, which would be the strongest possible signal of confidence in the business. The absence of insider buying is particularly damning for a stock trading at such a low valuation. If management genuinely believed the company was trading below intrinsic value, we would expect at least token insider purchases. The complete absence of such activity suggests that those with the best information access believe the downside risk outweighs the upside potential. The verdict: smart money is completely absent from Agricultural Bank of China. This is not a vote of confidence in the thesis. And finally, the verdict. Let's bring it all together. On valuation, the stock is cheap at 6.61 times earnings with a 42.69% implied margin of safety, but that discount reflects material unpriced credit risk rather than a genuine opportunity. On financial strength, the balance sheet is structured like all Chinese state-owned banks, with low leverage ratios that obscure the underlying credit risk and government dependency. On profitability, reported margins are distorted by accounting practices that defer credit loss recognition, so headline profitability figures cannot be trusted at face value. On growth, the company is essentially stalled, with single-digit revenue growth and no meaningful expansion drivers. On smart money, zero top-tier institutional investors hold the stock, 0% of 13F filers are buyers, and insiders are not purchasing shares, a complete absence of conviction from sophisticated capital. In our view, a fair value range for Agricultural Bank of China sits between $20 and $22, representing approximately 5 to 10% upside from current levels. However, this range assumes stable operating conditions and no material acceleration in credit losses. The latest quarter's reported revenue growth of 18.6% is not reassuring. Much of this comes from non-core income rather than sustainable net interest income growth. The core thesis around Agricultural Bank of China is that it trades at a discount to intrinsic value because markets fear credit deterioration in China's economy. That fear may be entirely justified. The company's low valuation does not automatically make it a screaming bargain. It may simply reflect that investors have priced in substantial downside if China's credit stress worsens. One might argue the case for a contrarian position at these levels, particularly for income-oriented investors who can tolerate volatility and are willing to hold through a multi-year period of uncertainty. However, the absence of institutional conviction and management's refusal to deploy capital via buybacks or insider purchases suggests even the smart money is not convinced. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Agricultural Bank of China Limited. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.